Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Tilley, Chief Economist at Wilmington Trust, Phillip Colmar, Managing Partner and Global Strategist at MRB Partners, and Joyce and Max Cabasso, Managing Directors on the Nasdaq Market Intelligence Desk. We'll be bringing Brian in for a technical read on the charts in just a moment. It is great to have everyone with us. Welcome to Trade Talks. And Philip, the Fed is intent on lowering policy, but the prints that they keep getting, it's not giving them much runway.
Yeah, it's really not. And I think the key is Powell kind of stuck himself out there, right, and said that policy is restrictive. And so if it is restrictive, then over time the economy should be working against it or slowing. It should be building slack, and it should be creating disinflation. And this first part of this year, and most of the economic data is pretty clear, I think, is signaling that we're not on the restrictive side of that ledger. We're still probably mildly accommodative. Fed's job isn't done. It's still going to look for a window to cut rates on any kind of softness in the inflation print. Inflation month to month can be pretty choppy, so it'll probably get a window for one, maybe two. But reality is we could be in the end of the year talking about hikes, not cuts, and whether the job's done, I think.
Yeah. So. Luke, do you see any cuts for this year?
Yeah, I think so. So a little bit of a different read on it. I think the first cut could come as early as July. The Fed came into the year thinking they would cut in May or June, I think, and first three inflation prints have set them on their heels a little bit in terms of their confidence level. Chair Powell has been pretty clear. He expects inflation is coming down, just the confidence level has been knocked a little bit, but by the time they sit down on July 31st, they'll have three more inflation prints. That's enough to convince them of that. And I think more fundamentally, if you look at the CPI data, and we'll get a new read tomorrow morning, if you take out shelter, then the rest of the CPI is running below 2%, at 2%, right around there for the past 11 months. So it's really just sort of this goofy lagged effect that's coming from shelter, and I think it'll keep heading down, and that'll enable them to cut.
Yeah, well, I mean, Max, we were talking about this earlier, on the desk, and even though inflation is coming down from a data perspective, the consumer is not perceiving it as such.
Yeah,
right?
I mean, over the 2-3 year period, it's at 25%. I know wages, according to the metrics, have maintained it, but anecdotally, I talked to a lot of people. They haven't seen 25% wage gains in their paychecks over the year, so they're kind of running behind. I know Chris on the desk has talked about it a lot about consumer kind of trading down, going down one level. Pockets are getting stretched. Credit card debt is at a new high, so it's still there. I tend to agree that their job's not done, but at the same time, they've been pretty clear that they want to cut. They're looking for a place to cut. It's just, are they going to get it? And if they see a slight window, are they just going to go ahead and do it? Because, like we've talked about, is 25 basis points, 50 basis points, is that really going to make much of a dent into anything? Is it going to change a ton? Is it really going to let things rip again? I don't really know. I don't see it making a huge difference, but potentially in housing, obviously they were talking about the $400 a month for helping with housing, and if you're going to buy your first house or upsize some more space, how they quantify that, I don't really know, but it's potentially,
Doesn't that mean more inflation, Philip, though?
Yeah, ultimately, this is the problem, is that right now the consumer sector and domestic demand is quite solid. So we saw a softer GDP print, but that wasn't done at domestic demand. The consumption's strong, Red Book surveys picked up, and I would differ on the inflation front that when you look at supercore shelter, so take out shelter, look on services, that accelerated back up, it's sticky. If you want to signal, has the Fed done its job as of this point? Is it building slack in the economy? Right now the output gap, so to speak, is closed. We're running above trend. We're reducing that slack. The consumer sector's consumption is strong, which is at the front edge of that supply-demand dynamic for inflation. So, yes, I agree that the Fed wants to cut rates here. It's going out, and it believes that inflation will fall lower, or it wants to believe that, and it'll take any window it can to cut rates. But the real test will be as the year progresses. Will inflation, and particularly supercore, which is a signal of its Fed's job, will it stay sticky? Yeah, we had a bounce in Q1, and some of that could come off, but will it be way north of the Fed's 2% target? And I think it will be. The economy is still going to be strong, and so I think that that's the challenge for the Fed, and ultimately the bond market as the year progresses. So it might get a window in the near term. I think that window closes, though.
Yeah. Well, let's bring in Joyce, our resident technical analyst on the Nasdaq Market Intelligence Desk here. Brian, it's great to have you with us as always. Welcome back to Trade Talks. Let's take a look at the rates from a technical perspective.
Thanks, Jill. Thanks for having me back. So here we're looking at the 10-year Treasury yield, and we can see it recently peaked up around 4.7%. And just with the weak jobs number, and really since the FOMC on May 1st, it's been pulling back here. So we're now testing this rising trend line that connected the lows from January and March. And just below it there, we have the 50 and 200-day moving averages, which could be a cluster of technical support there right between 433 and 440, so the last 4.44%. So I think we're seeing this little bit of a hockey stick pattern. I don't know if that's a bear flag, as technicians would refer to it, but we are a little bit lower today. The same thing for the 2-year yield. We're a little bit down today as well, despite the hotter PPI number. So it'll be interesting to see if there's some other longer term numbers and macro data that the market is looking at that is causing rates to be a little bit lower today. I was expecting maybe a little bit of a move higher with rates given the hotter PPI numbers.
All right, catch up with you in a moment here, Brian. Luke, let's talk about earnings season for a moment here. How would you have graded that for the first quarter?
Yeah, it's I think it looks pretty solid. Margins have come down a little bit. They're running about 8%. For the S&P 500. They've come down from their peaks, but we're still well above the profit margins that persisted in 2018 to 2019. A lot of that is on the tech side, but what we've seen are firms that are doing an incredibly good job dealing with still elevated wage increases and also the high interest rate environment. And I think that has played through to earnings. And we see that in the PPI data as well. It's running pretty low, even though the service firms have those high wages. They're able to manage and to basically increase productivity, and that's really helped on the earnings side. So we're pretty optimistic. At Wilmington Trust, we recently increased our allocation to U.S. large cap and to U.S. small cap because we think that it looks pretty solid for earnings going forward.
Right, and Philip, it was also broadening out of where we're seeing decent earnings too. It's not just specific to the basket of tech stocks.
Yeah, it is. We're starting to see that, if you will, it's an acceleration or a refirming in earnings, but on a broad-based scale. And it's and you're as highlighted, margins have been solid, earnings are picking up. And I think the market has really shifted towards that sort of soft landing, maybe a weakness or concerns about earnings at the beginning of this year to something more resilient now. And so then a lot comes play on where bond yields. As long as bond yields can go calm in that backdrop, then you've got good earnings without a threat to bond yields. I think that's good. But that broadening in the broadening in earnings, I would say, is spreading not only within the U.S. but abroad at this point. The trade cycle and manufacturing cycle is showing it back up. So we are seeing a broad-based improvement on the earnings front. I think that broadens out the rally here. So as long as bond yields don't come up and be threatening, I think the risk on remains intact based on earnings. But I think we see a real broader participation as we saw in Q1 beyond the handful of mega cap tech stocks to other sectors.
Yeah, and Luke, we're also seeing volatility recede once again as well, and there really hasn't been that much volatility despite a few down days here. It seems as if the market has done a decent job of being able to reprice Fed risk. To your point earlier, we were coming in with the expectation of 6 to 7 cuts this year, and now we're debating if we'll get 1, 2, maybe 3.
Right, and I think that touches on multiple things. One, stocks tend to do pretty well, even if the interest rates are high. It's such a small part, the interest rate actual cost is such a small part of their overall cost structure. If the economy is strong and if profits are strong, if revenues are strong, then they're able to manage through that. And the reduction in the VIX really comes from a reduction of uncertainty. I mean, beginning of the year to late last year, so much uncertainty about the Fed, and was inflation really going to reaccelerate? Yes, we've had some disappointing prints early in the year here, but the trajectory is still down. You still have the Fed saying, basically, we're taking rate hikes off of the table. It's just a matter of when we start cutting. And if you've got global central banks, because we're also talking about the ECB, the Bank of England, the Federal Reserve are all looking towards that cutting cycle. For equities, if you're a longer-term investor, you're not really thinking about, are they cutting in June, July, or September? It doesn't look like a good outlook for profits going forward, and I think it looks pretty positive. So, people are piling in for sure.
Well, it's interesting. We talk about the stress in the housing market just because there's lack of supply, but when you look at the way the home builders have performed relative to the S&P 500, it tells a little bit of a different story.
Yeah, they've been strong. I mean, look, you need the supply. People obviously are going to work on their houses. Not like we saw in COVID. We're kind of back to that pre-COVID levels where everybody's kind of that's worked its way through. But I mean, look, you need extra supply here. The demand has been the problem. So again, they're pretty strong. I think people are more confident. Companies are more confident. Like you said, VIX is lower. They've adjusted to the higher for longer rate environment. There's not as much of the shocks. Okay, we're getting a hike every 2 weeks or every meeting. When is it going to stop? Or we're expecting cuts 6. Okay, now we're at 2. They're calmer. They can expect it. We were talking about it on the desk earlier. I had a conversation with one of our companies earlier today. We've been talking about how companies are kind of doing short-term funding. If they're going into the debt market, short-term, waiting for rates to come down. company I spoke to today said, we're actually just going to look to lock something in longer term, probably in the double B rating, look something longer term, pay off their short-term debt. They're more comfortable here. The outlook for what they're seeing in their business is strong, so they said, okay, we're okay to lock it in here, get rid of the short-term debt, lock it in, we're okay, and they're not as worried about trying to time the market as much. All right, we get 2 cuts. That's what we're priced in at this point. Probably not going to get much more. Maybe long-term terminal rates, 3.5, in a few years potentially. So not a huge amount, to the downside. We're not going back to zero.
Right.
So companies are more confident in what they're seeing, that the volatility is not there. They're not trying to time it or worried that if they're going to do something, it's going to look silly in 6 months. So they're more confident, going out and locking that in.
Yeah, I mean, Phil, there's no expectation that we're going to see, rates at 2 to 3% like we saw during COVID. I mean, that was a special situation. And in fact, when you look at mortgage rates or rates in general over a longer chart there, we kind of are in a normal environment. We're just like used to it.
Yeah, we're not used to it for a couple of reasons, because not only we had COVID, but preceding that we had the biggest deleveraging cycle after the housing crash here, not only here but in Europe, so Euro area. So the 2 of the major sources of final demand went through a massive deleveraging cycle. And unfortunately, the Fed and the bond market has predicated their beliefs about long-term equilibrium inflation rates of 2% and what the growth of the economy should do based on that period, which is a very outlying period of history. So that inlines the risk ultimately. But you're right that those were outlying periods of history which dampened inflation and dampened interest rates. We're not going back to that. We're normalized. We're in the process of normalizing. I would say where the misallocation is still within the bond market would be at the long end, the premature inversion of the curve. That hope that somehow a low 2.5 or 3% is long-term equilibrium Fed funds rate, which is also predicated on a secular stagnation narrative that doesn't exist anymore. So I think right now we got a window where the Fed wants to cut. We'll get some potential easing if it gets a window to do that. As long as rates and bond yields stay calm, equities do okay. I think it plays into more difficulty as the year progresses and into next year, that if inflation is sticky and people have to rethink inflation. You said before interest rates rose and the market was okay. Well, that was because we raised up growth expectations at the same time. They surpassed it. If we've already raised up the growth and earnings expectations, but now we have to deal with higher bond yields, not because growth is getting better, but because inflation is perceived to be sticky. That's where I think you get that volatility in the mix again. But that's down the road. It's not in the near future. It's later this year into next, probably.
Yeah, and look, it's quite impressive how corporates were able to pivot as well. I mean, there was a period of 12 to 15 years where the system was so flush with liquidity and we were at 0 interest rates, and then they had to make that really quick pivot in under a year, and they seem to have managed it, for the most part, pretty successfully if you have a decent balance sheet and you're kind of in the sweet spot of the market.
Yeah, so flush with liquidity, and I agree with the point about interest rates not going back to where we were. The economy was so scarred after 2008, 9, and 10, and interest rates were so low. What was the average 10-year in that time? Like 2.5%. We also think that we've returned to a time of more equilibrium where the 10-year is probably going to average around 4 to 4.25. Equilibrium Fed funds rate about 2.5, and corporates are going to take advantage of that. They've got higher inflation now, which helps their selling prices of their goods. They can price that in, and even with the higher corporate rates, we know that the spreads are so tight. With the positive outlook for the economy, the spreads to treasuries are really low, and they can really take advantage of that because they can finance longer-term investments, and they're really looking at a solid economy. So yeah, they've got the appetite for it. It looks like appetizing financing, and we're in a world where all asset classes are performing pretty well with that broadening. It's not just the tech and sort of the ones that live on future profits like we had just before the pandemic.
Yeah, and we'll get to that in just a moment here, but I want to bring Brian back in and get a more in-depth look of housing versus the S&P. Brian, what can you point out to us there?
So right here we're looking at the multi-year chart going back to the 2020 lows of the Home Builders Index. The ETF is ITB, and just more recently, since the Q4 lows, this ETF has returned over 60%. That's more than double what we saw with the S&P 500 and the Nasdaq 100, which up for about 28 to 30%. So just very powerful moves there. If we go back to the returns since the lows of 2022, this ETF is up 140%. That's the S&P 500 over that time is up about 50%. If we look at a ratio, which is the relative strength of the ITB over the S&P 500, we could see, going back to its bottom here in 2022, it's just been, a very strong move higher. So that's just showing the outperformance of the ITB over the S&P 500. And as your guests were speaking to earlier about small caps, the Russell 2000 Value Index, we can see it's now here up again against a let's call it a 20-month resistance level. And really since the start of 2024, it's been holding at the top end of this range, despite the fact that we've had a repricing, a hawkish repricing of rates across the entire curve. And then if we look at individual Russell 2000 sectors, the industrials, have been the leader. They've been breaking out to new highs since late December. Staples last week broke out from a 20-month range. Materials is just on the cusp of doing the same thing. That's about a 2-year range. And energy right now looks like it's coiling into a pattern of higher lows, into that clearly defined resistance going back almost 2 years as well. So we're seeing that rotation. It's not just the tech and the growth that's doing well. Yes, the large cap Mag 7 is still dominating with the alpha and the outperformance, but breadth to me is still good. More than 78% of the S&P 500 trading above its 200-day moving average. Just last week, the advanced decline line in the S&P 500, that's the blue line here in this lower pattern, made a new all-time high, and this was a very good early indicator from mid-23 when it broke out in June of 23 to all-time highs. So I think we're really seeing a strong, healthy rotation underneath the hood of the surface, even within small caps.
All right, Brian, appreciate the insight as always. And really that lends to, both of you have noted that you're looking to move or have moved into financials and energy, but I feel like the market's moved beyond the AI trade and what stocks have exposure to it, and they're thinking, deeper into it, what utilities, what energy companies, private-public partnerships, and how we're going to power all of this emerging technology that's coming on the scene. So I think we're kind of like out of that AI exposure.
We're probably out of the direct AI exposure in terms of who's making the chips, and really it comes down to who's going to benefit from it, and that's really economy-wide. We use it in financial services, and it's used and it can be used to increase productivity across the board. So there's a couple of waves here with people that can take advantage of AI. But for an economist, if it increases productivity just by a couple of % a year for everybody across the economy, then it's going to provide a boon for long-term economic growth. This is very much like the internet of the the late 1990s and getting into the 2000s, where once it was a beneficiary of all, it really powered productivity growth. So I agree with you. We're sort of past that initial stage in a lot of the chip makers. There's going to be some secondary impacts, but we're really looking for long-term growth to benefit from this. And the U.S. is really well positioned to take advantage of this more so than international economies. The European Union already looking like it's going to regulate AI more stringently, much like it did with consumer data. And so we think that that's a boon for the U.S. relative to international stocks.
All right. And final thoughts here, Philip?
Yeah, I mean, I agree with most of that. The same thing is I think the initial flare was in the chip makers, and now it's looking for broadening. But also in a world where we're talking about earnings being strong and more durable, bond yields, our interest rates being higher for longer, I think you want to get out in the spectrum of places where earnings expectations are not so high on a multi-year basis, like some of those AI-related plays. And so that lends yourself into financials. It lends yourself into energy, some of the industrial space. So I think there's a broadening, even independent of the AI theme, and broadening out. I think that there's other pockets of the market that just offer attractive value and lower earnings hurdles to get over. It'll be easier to achieve them, and you'll get some upside. And I think you're seeing that rotation already play out.
Yeah, all right. Certainly something new to talk about for us. All right, everyone. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.